Good morning, everyone. My name is Denise Appleby, and this is an episode of IRA Conversations with Denise Appleby. Today, I'm going to be talking about IRS Form 5498 with my very good friend, Louis Robinson, CPA. Good morning, Louis. How are you?
Good morning. I'm fantastic, Denise. Glad to see you this morning.
Great to see you too. Now, before we begin, why don't you tell our audience a little bit about yourself and your business?
I'm managing director and senior financial advisor with CapSouth Wealth Management in the McDonough office. I'm a retired CPA, started a CPA firm and retired and sold it several years ago, and wasn't ready to retire. I wanted to do something I had a passion to do, which is working with clients in retirement, in particular on the IRA areas.
Now, one of the things you always say, I hear you say, is your dad told you not to retire from something, to retire to something. I really like that.
Yes, he did. He told me that, and I tell that often to when I was talking to clients who are getting ready to retire. You don't want to retire from it. You want to retire to. It may be the golf. It may be another job. It may be just something to make you get up every morning. Whatever that takes to make you want to get up every morning. That's what you need to retire to.
And life expectancies are getting longer, so you know, it makes sense. You keep active, you have a better quality of life. So now let's get into why we're here. We're talking about Form 5498 because they've recently been mailed out to clients. That typically the deadline for mailing Form 5498 is May 31st of the year that follows the year for which the contributions are made. But as sort of a flow or overflow from the 2020 pandemic, the deadline was postponed by the IRS to June 30th. So the 2020 Form 5498s, the deadline to send out those to clients by financial institutions was June 30th, 2021. So, Louis, what do you think about us going box by box on the Form 5498, at least the key boxes, and you can tie in some of the questions that you're getting from clients about Form 5498. How does that sound?
That sounds good. And just initial comment is not related to any of the boxes, but I always get a call is, why did I get this after my tax return has been filed, which is the general case. So.
Yeah, excellent question, because, and here's why that is alarming to some taxpayers. When this is mailed out on May 31st, typically, you have already filed your tax return. And the envelope that it comes in says this is a tax form. So now you might panic a little bit saying, oops, here's a form that I need to give to my accountant to file with my tax return. But yes, you need to give it to your accountant, but it's not required to be filed with your tax return. Go ahead.
Well, one of the things I would recommend, that as a CPA and see what happens, I would really recommend the client take that form, probably even have a folder to put that 5498 in. Always carry it forward to each tax year so that at the end, 10 years, 20 years, whatever it is, in that folder, you have every 5498 that's been issued over your lifetime. You may not ever need it, but you could, and you're not going to be able to get it if you don't keep these forms, because your accountant is not going to keep a record of them.
That is such an excellent recommendation, and I think it is for many reasons, including the fact that one of the contributions we're going to be talking about is Roth IRA contributions. Those are not reported on your tax return. So how do you keep track of it, right? How do you keep track of non-deductible contributions? So
and the key word is you, because you have to do it.
Exactly. You're the one who's going to be responsible for determining whether or not your distributions are subject to income tax based on how they were treated when the contributions were made. So let's start with box one. This is the one that most people are familiar with. Traditional IRA contributions. Those are reported in box one. Now, traditional IRA contributions, can be made by tax filing due date for the previous year. So contributions for 2020 could have been made as late as April 15 of this year. Of course, the IRS postponed that deadline to May 15. Any comments on that box, Lois?
Yes, because when you make a contribution in January through April for the prior year, when that is submitted to the custodian, you have to identify which year it's for. And it's really easy to either do it wrong or not do it correctly. And bottom line is their records won't tie in with your tax return. So you need to make sure this box here ties in with your tax return, or your advisor may have reported it incorrectly.
Absolutely. And the regulations say if you send in a contribution in January and you didn't tell the IRA custodian that it was for the previous year, the IRA custodian has the right to treat it as a contribution for the current year, the year that they received it. So I agree with you. And that's one of the benefits of Form 5498. If you're just receiving your Form 5498, check the IRA contribution box to make sure that any contribution that you made for the previous year is in fact being reported for the previous year. And if it's not, then that's a reason to call the IRA custodian and say, looks like you made a mistake. Let's talk about how that can be fixed.
Right.
Now, box 2 reports rollover contributions. Before we get into that, I want to remind the audience that this reports contributions for IRAs. So right now we're talking about rollover contributions. These are rollover contributions that are made to SEPs, simples, traditional IRAs, Roth IRAs. Rollover contributions made to your 401k accounts are not reported on this form. Any comments on that box, Lois?
No, I think you covered that one.
Yeah, and we just talked about the fact that you can make a carryback contribution for a traditional IRA contribution. So you could make your contribution up to your tax filing due date for the previous year. It's different with rollover contributions. Those are reported in the year that the custodian receives them. Now, here's a problem I usually come across, Lois. A distribution is made, say, in December of last year and rolled over in this year within the 60-day period. And so the customer has a 1099-R and they don't have an offsetting Form 5498. So now they're looking at the Form 5498 saying what's going on. Well, because it was rolled over this year, it's going to be reported on the Form 5498 for this year. So in that case, you want to provide your CPA with a copy of your actual account statement as proof that the rollover was done timely so that the CPA can report it as a non-taxable distribution.
As an advisor to clients, one of the things we always try to do is when things like that happen is try to make those happen early enough so that you don't have those cutoff problems.
Exactly, exactly. I absolutely agree. It's hard though when you take the distribution, say December 31st,
right?
You get it over within 60 days. The next box is Roth conversion amounts, and these reflect amounts that are converted from traditional SEPs and simple IRAs.
And here again, that's a calendar year.
It's a calendar year. Now, one of the questions I usually get is then, what about my conversion from my 401k, from a traditional 401k to my Roth IRA? Well, those are reported as rollover contributions. Those are not reported in the Roth conversion box. Now, here's a common mistake that IRA custodians make with this box. There are two ways to do a Roth conversion: indirect and direct. With a direct Roth conversion, you'll go to, say, custodian A and tell them to convert your traditional IRA to your Roth. Those they report correctly. What they're not reporting correctly are indirect Roth conversions, where you take a distribution from a traditional IRA and you roll it to the Roth IRA within 60 days of receipt. Some custodians are reporting these as rollover contributions, and they shouldn't. And the IRS has acknowledged that this is one of the common mistakes that IRA custodians are making, and it creates a tax issue for the client, because especially if they're on age 59 and a half, they have a 1099-R showing it's an early distribution, and they don't have an offsetting form 5498 showing that it's a Roth conversion, which would automatically exempt them from the 10% early distribution penalty. So hopefully there are some compliance officers with IRA custodians who are listening to us today, and we'll check with their processing department to make sure that they're doing the right thing. Recharacterized contributions, Lois. We don't have recharacterizations of Roth conversions anymore. Conversions that are done after 2017.
17, right? Yeah, unfortunately.
Recharacterize anymore. But we can recharacterize a traditional IRA to a Roth IRA regular contribution and vice versa, right?
Right. Yes, you can.
So one of the questions I usually get is, why would someone do a recharacterization? Well, you make a contribution to a traditional IRA, you change your mind, you want it to be a Roth IRA contribution. You can do that as a recharacterization. Check though to make sure that you're eligible to make a Roth IRA contribution.
And we've had people make ineligible contributions because of the income and other plans. So that's another case where you would wind up recharacterizing that, taking that contribution out.
Absolutely. And before 2020, when the IRA age limit for regular contributions to traditional IRA was 70 and a half, before then, you would recharacterize a contribution to a traditional IRA if you didn't meet the age limit.
Right.
That's not an issue anymore, because under the Secure Act, anyone can make a contribution to a traditional IRA now, as long as you have eligible compensation.
Yeah, just be careful if you do qualified charitable distributions, though, if you do that, if you're over 70 and a half and over 72 rather.
Yeah, it's an excellent point. Yeah, so what is Lewis talking about? If you're at least age 70 and a half, you can take a distribution from any IRA as a qualified charitable distribution donated to an eligible charity. There's certain other requirements that must be met. Now, if you meet the requirements, your qualified charitable distribution is tax-free. Before 2020, that was cut and dry, because the age at which you could start making a qualified charitable distribution coincided with the age cap that I just mentioned on traditional IRA contributions. Now that that age limit has been repealed for traditional IRA contributions, you're going to find that people are doing both at the same time, making a traditional IRA contribution and then making a qualified charitable distribution from your IRA. The problem comes in, though, if you claim a tax deduction for your traditional IRA contribution. Well, Congress says if you do that, then your qualified charitable distribution is going to be reduced by the deduction that you claim for your traditional IRA contribution. So not all of it's going to be non-taxable.
And that's not done year by year. That goes back if you didn't do a charitable donation one year and you do it next year, they'll go back to that first year that you made that IRA deduction. So that's not cumulative.
Right. It aggregates, it rolls up.
Yeah.
And if you have questions about something like that and you want to talk to someone like Lewis, now Lewis is unique in that he's both a financial advisor and he has a CPA background, which is why he's speaking all that CPA language mixed in with the IRA language. Next box is number 5, fair market value. This is used to report the market value of your IRA as of December 31st of the year that the form is issued for. Right now, we're looking at the 2021 version of the form. So when this is issued next year, it's going to show the fair market value for December 31st, 2021. And that fair market value is used for a bunch of things. Let the IRS know how much money you have in your IRA as at the end of the year. And it is used to calculate your required minimum distribution for the year if you're subject to RMD for the year.
And I believe this form, just going down, they're going to give you the RMD amount, but there may be occasions when that's not correct. If your spouse is 10 years younger than you or more than 10 years younger, you're going to have to calculate it yourself.
Absolutely. Excellent point. So I just mentioned that the fair market value is used to calculate your required minimum distribution. And I agree with Louis. The formula appears to be simple. You get the fair market value for the previous year, and then you use that to calculate your RMD. But there are instances where adjustments might need to be made to the fair market value to calculate your RMD, such as in the rollover example that we talked about earlier. You take a distribution in January, you roll it over, you take a distribution in December and you roll it over in January. That's not going to be reflected in the fair market value that your custodian reflects on their accounting system, yet that is what they're required to use. So now you're going to have to talk to your financial advisor or your tax advisor and let them know that you had what is referred to as an outstanding rollover or an outstanding transfer. Those are amounts that should be reflected in the fair market value, but wasn't because they weren't in the account as at the end of the year. And another point that Louis was making, the RMD calculation that we're going to be talking about earlier, custodians are required to provide an RMD statement. So we'll talk about that as when we get to those boxes. Good point, Louis. Thank you. Box number 7. This is used to indicate the type of IRA, whether it's a traditional, SEP, simple, or Roth IRA. I think that's self-explanatory. So I want to jump ahead to boxes 8, Lois, and box 9, which is used to report contributions to SEP IRAs and simple IRAs. And I thought it was important that we talk about this box because unlike traditional IRA contributions and Roth IRA contributions, where if they're made in the current year for the previous year, the custodian is required to report them for the previous year if they're made by the deadline. So you make a traditional IRA contribution in March of 2021, and you tell your custodian that it is for 2020, then they're required to report it on the Form 5498 for 2020. SEP IRA contributions and simple IRA contributions are different. If the custodian receives it in 2021, they're required to report it for 2021, even if the employer is saying this is for 2020. So you're going to have a lot of cases where there's a discrepancy between the Form 5498 and what the employer reports on the employer's tax return. Don't be alarmed. That's okay. It is something that the IRS expects. It's not something that the custodian has any control over, because here's why. We just talked about the fact that the deadline for the custodian to issue Form 5498 is generally May 31st, right? Now, contributions to SEPs and simples, employer contributions, can be made by the tax filing due date plus extension of the business, which means that for many, they're going to be making these contributions long after Form 5498 has been issued. So there's no way to reflect those on the forms. Recognizing that that could be a problem, the IRS said, okay, forget it. Just report those contributions for the year that you actually receive them and have the employer take care of it as they are required to on their tax return.
And I can tell you close to 100% of the time, those contributions are made after the year end, not during the year, because the accountants usually calculate what the deduction is going to be. And that's after December 31st, because you don't know what the payroll is until you get W-2s.
That is true. I absolutely agree. I don't know why I don't keep on my glasses, Louis. I'm pretending that I don't need them, but I obviously do.
Yeah.
So the next box is box 10, which reports Roth IRA contributions. And these are regular Roth IRA contributions. The rules for reporting and the deadline for making the contributions are the same as those that apply to traditional IRA contributions reported in box 1. And I just want to reiterate what Louis said earlier. When you send in these contributions that are made in the current year for the previous year, you want to make it clear to the custodian what year it is for. And these contributions are not reported on your tax return, right, Louis?
Right. And if that box has a number in it, that makes this form a permanent file that you need to keep indefinitely.
Perfect. Perfect. Next box is 11. Check if it's an RMD for the year. Now we're looking at the 2021 version of the form here. All right, this is going to be issued in May of 2022. So you'll see here that this box says check if RMD for 2022. If we were looking at the 2020 version of the form, box 11 would have said check if RMD for 2021, which means this alerts you to the fact that if you're at least age 72 by the end of the year, then you're required to take a required minimum distribution from the account. Anything to add, Louis?
Yes, I don't have any comment on that. That's pretty clear cut, I think. And
right.
And keep in mind, well, keep in mind, because it tells you what the RMD is for this account, that you don't have to take the RMD out of this particular account. In fact, most all my clients, we aggregate them and take them out of one account so that we don't have RMDs coming from multiple accounts. We do that for several reasons. One, generally it's coming out of a cash account to one that's not in a market. And so we don't take them out of the individual accounts.
Excellent tip. Excellent tip. I think that's very helpful to a lot of people who have multiple IRAs and don't want to take all their RMDs from each IRA. And so the question becomes, Louis, when is that permitted? When can you aggregate RMDs? Meaning if you have multiple IRAs, when can you calculate the RMDs separately and take it from, say, one of those IRAs?
As long as it's an IRA and not an inherited IRA, you can't aggregate the inherited IRA. In fact,
Exactly.
they don't even tell you how to calculate it, because I'm not sure they even know how. So you have to calculate that yourself. And that one, inherited IRAs are painful to calculate, to be honest with you.
I agree. If you have multiple traditional SEPs and simple IRAs that you own, you can aggregate RMDs for those. If you have multiple inherited IRAs that you inherit from the same decedent, you can aggregate those. Now, this box is not going to be checked for an inherited IRA because the IRS says the custodian is not required to provide any type of reporting for RMDs for inherited accounts. Now,
I want to just clarify one thing. You said it correctly, but I want to go back and just emphasize it. You can aggregate it if it's from the same deceased person, but if you have multiple IRAs from different people, inherited IRAs, you can't aggregate those.
That's right.
Like if you had your mother, like if your mother, you had one inherited from your mother, one inherited from your father, you can't aggregate those.
You cannot, right? Yeah. Yeah, I have to say cannot because when I say can't, you know, sometimes people don't they're not clear. Is she saying can't or cannot? So I like to spell it out. But I agree with you. And also, Louis, if you have multiple, say an inherited Roth and an inherited traditional, those cannot be aggregated either. Now, what I see a lot of people doing is aggregating RMDs for different types of plans. Like you have a 403B and an IRA, they're aggregating RMDs for those, and you cannot do that. You can only aggregate multiple 403Bs or multiple traditional IRAs, which for this purpose includes traditional SEPs and simple IRAs.
Right. But when and if you roll a 457 or a 401k into an IRA, then it comes under the IRA rules.
Right, I agree. If you say you roll over a 457, 403B, or 401k to your IRA this year, then it's going to count in your RMD for next year because that's when it's going to be reflected in the fair market value as at the end of the year. But you roll it over this year, it does not affect the RMD for the IRA this year. it only applies to the RMD from the plan that it's being rolled over from. So the RMD for that account should be satisfied or distributed before the account is rolled over to the IRA.
One thing I just want to mention, because we've done this on several occasions and never had an issue with it, and I hope you're not going to tell me there is an issue, but we've had clients who have not paid in estimated tax payments and withhold enough in December out of the RMD to cover the tax. In fact, I've got one client, typically 98% of his RMD at the end of the year is going to taxes because he hadn't paid his estimated tax payments. And you get credit for that like you paid it all during the year. Eliminate any possibility of penalties you might have made for failure to file estimated tax payments.
Yes, I fully endorse that. The IRS has confirmed that it's a perfectly legitimate strategy. And it's good when you're reviewing your taxes at the end of the year and your accountant says you didn't pay estimated income taxes, now you're in trouble. Well, I agree with you. An easy fix is to have the amount withheld from a distribution from a retirement account. Excellent tip, Lois. Excellent tip. So box 12 is going to have the RMD date. Box 12B, RMD amount. The other boxes are not as common, so I'll just go through them very quickly. Box 13, 13A, 13B, 13C has to do with postponed contributions. That are certain contributions that are allowed to be made after the usual deadline. Special rules apply. If you have any questions about those, then you want to contact your financial advisor like Lewis. Repayments apply to certain type of distributions that were allowed at dispensation from the regular rules. Like last year, we had coronavirus related distributions. Those can be rolled over within 3 years as opposed to the 60-day, usual 60-day deadline. Those rollovers are referred to as repayments. Now, we don't know yet whether or not coronavirus related distributions should be reported in this box. It's safe to assume that it is, but there is no specific guidance to that effect. But there are similar type of distributions that were made in previous years and last year as well that are not coronavirus related distributions that would be reported in this box when they're repaid. Fair market value of certain specified assets and the code. This is very important for those of you who have non-traditional assets, assets that are not publicly traded in your IRA. So you buy real estate in your IRA. The IRS wants to see the fair market value of those assets in this box. Now, if you've been following the financial news, you'll see where Peter Thiel made a contribution of $2,000 and now it's worth $5 billion to his Roth IRA, which means he has $5 billion of tax-free income to get. Well, this is how the IRS tracks to see the growth of his IRA, of his Roth IRA over time. So if you have these non-traditional assets, make sure that they're valued correctly from year to year so that if the IRS needs to audit your IRA, they'll see how the growth has occurred. Any final word for our audience, Lewis?
I don't think so. I just want to emphasize again how important this document can be, and it's particularly important for a young person who's making contributions to a Roth, and they may take the money out before they're 59 and a half. Their contributions are not going to be subject to a penalty or anything, but if they take out the income, it will be subject to penalty and income taxes. And the only way you're going to know what that growth is to keep up with this form over your lifetime.
Excellent. Excellent tip. I absolutely agree. So keep these forms. Nowadays, we have so many options for keeping forms. Years ago, you had to print them and stick them in a folder. You don't need to do that anymore. Download these forms, keep them on your computer in a hard drive or in Google Drive or anywhere that you know your financial information can be safe. And some custodians keep them forever if you have your account with them forever. That might not be the case, so make it your responsibility to keep these forms.
Well, I had the same conversation with my relationship manager, and of course, she's young and keeps everything on the computer. I says, what if your computer crashes? What if somebody steals it? You don't have any record. I would still keep the paper copy of something like this.
Yeah, well, what I do is I'll keep them on my computer. I also have them on an external hard drive, and I have a backup to the external hard drive, a paid service, and also Microsoft. So there are two different services. So I have backup of the backup of the backup. And one of the benefits of having that paid service, Louis, is if your computer crashes, they'll restore your computer up to a certain point.
I understand all of that, do the same thing, but I still recommend the paper, because that paper will be here unless it's in a fire or something.
All right, Louis's final word. We want to thank you for joining us today. You have been listening to an episode of IRA Conversations with Appleby. My name is Denise Appleby. My guest today is Louis Robinson, CPA. Follow me on social media at Appleby IRA, where you could see all my episodes of IRA Conversations with Appleby and other important information that helps you to properly manage your IRAs and 401k plans from an operational and technical perspective. Thanks again. Have a great day.
Thank you. Goodbye.